Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Kevin Mahn, Chief Investment Officer of Hennion and Walsh, to discuss investment opportunities in stocks and bonds for the short and long term. Kevin, it's great to see you as always. Welcome back to Trade Talks.
And you as well. Let me just start by wishing you a happy National Pizza Day, Jill. I got my slice waiting here for me after the show.
All right, now I know what I'm going to have for lunch today. Kevin, before we get into the long and short-term opportunities, I want to get your perspective on the debt ceiling debate and what are some of the potential ramifications of it?
Certainly, and I think we need to put that debate into perspective, Jill. Since 1960, Congress has met 78 times to either raise the debt ceiling, extend the maturity of the debt debate, or change the definition of what is included in the debt ceiling. We've never defaulted on our debt. The ramifications would be significant. Both parties know that. So it's just a question of negotiations and ultimately when it gets decided. Not if it gets decided, not if it gets raised, but when it gets raised.
What's your outlook for the U.S. economy? And do you think we're going to enter that recession in 2023? This is a recession that's never happening, apparently.
Yeah, it's hard to imagine, Jill, us not entering a recessionary period. And we'd have to also remind all the viewers that this would be a double dip recession, as we did hit the technical definition of recession during the first 2 quarters of 2022. But when I say that, I also saw an update from GDP Now that forecasted Q2 GDP at 2.9%. So if the Fed's year-end projection of just 0.4% growth is accurate, that means we got some rough roads ahead, and the second and third and ultimately fourth quarter are going to be sluggish and in all likelihood enter recessionary waters. However, here's the catch, Jill. If in fact the Fed does stop raising rates, if that May hike of 25 basis points was that last one, this recessionary period could be relatively shallow and relatively short. If they continue to hike, well, that's going to make this recession that much more protracted and potentially that much deeper.
Kevin, you and I have spoken about this before, but a recession is a natural part of the business cycle. It doesn't necessarily mean things are going to completely fall apart.
That's absolutely true. And that's the normal part of business cycles. And we are entering an economic slowdown. We've had 2 consecutive quarters of earnings decline. We're seeing GDP continue to struggle. And we're now starting to see the great all-American consumer that continued to spend all throughout this massive rate hiking campaign now showing signs of stress. I even saw a statistic earlier this week that suggested that total household debt in the United States has now hit an all-time record at $17 trillion. So yes, consumers continue to spend, but now they're dipping more into their personal savings, putting more on their credit cards to keep up with inflated prices. How much longer can that last? I don't think much longer. And with an economy that derives 70% of its growth from the consumer, that becomes a major concern.
So when you think about investment opportunities in stocks, specifically over the short and long term, where are you looking?
Great question. So we did the research here at Smart Trust to identify those sectors that have historically performed best when rates are declining. Yes, rates are declining, not rising, because I don't think we're that far off from the point in time when we're going to be in a declining rate hike cycle, perhaps the end of this year or early next year. Regardless, when that does occur, sectors such as healthcare, consumer staples, and even information technology historically have fared best. We should also remember that rates don't get cut generally when the economy is doing well, rather when the economy is doing poorly. And those 3 sectors historically perform well during periods of economic slowdowns up to and through recessionary periods. But I would just remind all investors to look out a little bit further, because the further you look out, Jill, the more clear the picture becomes. 2 years out, rates should be lower, yield should be lower, inflation should be lower, and in all likelihood, markets should be higher.
So then what's your outlook for the bond market then? Where should we be looking for investments?
One great area that we see right now is around municipal bonds from a supply-demand perspective. In fact, by the end of 2026, nearly 1/3 of all the outstanding municipal debt in our country is due to either mature or be called. We also know that last year was a historically low year for new supply of municipal debt, down 20%. And thus far in 2023, it's down another 18%. So as investors still demand tax-free income, and as the supply of municipal bonds become constrained, that should help push up prices even further. We also have to remember that 2022 was a very difficult year for municipal bonds, for fixed income, and for equities altogether. So they're poised to experience a rebound, and we think that supply-demand imbalance is only going to further fuel that rebound in the months and even years ahead.
All right, Kevin, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.